All right, welcome back. Here we are. We're jumping into module 5. In this module, we're going to be talking about understanding interest. But before we get too far into that, just like we usually do, we've got to go over our disclosure here real quick. I am not a licensed attorney, accountant, financial advisor, broker, agent, or any other licensed individual. Even if I had a license, I'm not acting in this capacity. I'm just simply sharing some knowledge. The purpose of this module is to educate you. This is not specific information or advice. This is just general educational information. So, with that said, let's dive in. Let's talk about interest for a second. What is interest? Well, interest is money that's paid on regular intervals at a specific rate for the use of money lent or for the delay of repayment of a debt. So it's just it's interest is a service charge to borrow money from someone else because you don't have enough to do what you want to do. So you're going to pay them for the service of lending you money. That's all it is. It's a service fee. It's also the cost of using someone else's money or controlling cash flow, and it's a metric for your relationship with the person or entity that you are borrowing from. How do the wealthy view interest? Well, the wealthy view interest as a tool. Just like many other things, interest is a tool that we can use. However, we want to make sure that we're using it in the way that best suits us. I feel like a lot of the things that we're taught in public education, they don't inform us enough to make good decisions, and it causes us to use interest in a way that's actually bad for us, that ends up hurting us. The wealthy view interest as a way to maximize their rate and length of collection when acting as a lender, and they view it as a way to minimize the amount paid and to limit the length of time it is in use when acting as a borrower. So the question, would you pay a higher interest rate for control of your cash flow? Now, that's a trick question because that's exactly what we're doing with the speed banking principle. A lot of times we're using instruments that have a higher advertised interest rate, but because we can control the cash flow, we can pay that debt off faster, which causes us to spend less overall in interest than if we use a different product that would force us to stretch that repayment out, thereby paying more in interest. So that's the key to understand, is that this is a cash flow strategy. This is not an interest rate strategy. The power comes from cash flow, even if we end up using tools that have a higher advertised interest rate. So let's talk about amortized interest for a second. If you remember back to our example here, interest on amortization is front loaded. So when we're looking at the front end of a amortization table, the part below the blue line, in the case of a payment, is going to be what's paid in principal. The part between the blue line and the red line is what's going to be paid in interest. So it's front end loaded, and then as we get through here towards the end, towards the back end, it's the part below the red line that's paid in interest, and the part between the red line and the blue line that's paid in principal. So you can see amortization is designed with the idea that you will pay more interest on the back end, more principal on the back end and more interest on the front end. And then they use that to their advantage in their advertising to get you to refinance, to get a new loan. In the case of a house, they either want you to refinance or move and get a new loan, or in the case of a car, they either want you to refinance or get a new car. This plays to their benefit by front end loading this interest, which kind of keeps us paying mostly interest all the time. And that's why people never get out of debt, is because of tools like this. And then we're told by them that they're much safer. Well, they're not safer for us. They're safer for the bank. They're not better for us. They're better for the bank. So when they're saying they're safer, they're better, they're talking about for them. They're definitely not safer and better for us if we understand what we're doing and how to use these tools that the bank provides us with. So here's how the bank calculates a payment amortization. And I know this, for a lot of you, this probably looks like Greek, right? But for you mathematicians out there, you'll understand this. Basically, how they calculate a monthly payment is they take the annual interest rate and the monthly interest rate, and they times that by the principal. And then they take that and they times it by 1 plus the interest rate to the power of the number of payments. So they take that and then they divide it by 1 plus the monthly interest rate to the power of the payments minus 1. So I know that's a lot, and you don't necessarily have to understand that, but for those who really understand math and can dive in, this is how a payment is calculated, which basically comes back to this, right? This is what it looks like when you draw it out. This is how amortization is calculated. So let's use an example of amortization. Let's take this little $400,000 house and let's give it a 4.5% interest rate. Our monthly payment on that, so if we plug it into that equation, our monthly interest rate, which is your annual interest rate divided by 12, so that gives us 0.00375 times the total principal, which is 400,000, times 1 plus the monthly interest rate to the power of the number of payments, which will be 360, a 30-year loan, right? You take that number, so you work out that top part of the equation first, find the number, and then divide it by 1 plus your monthly interest rate to the power of the number of payments minus 1. That gives you a total monthly payment of $2,027. So by taking that, we take the total interest rate amortization formula, and we're going to find out exactly how much interest we're going to pay. So we take our total interest, we times it by our monthly payment, times the number of payments, and minus the total principal. That will give us a total interest of $329,720. So think about this. Our principal on it was $400,000. We're going to have to pay back that principal, but we're also, over the course of 30 years, going to pay an additional $329,000. We are paying almost double. And this is true for almost any mortgage out there. You saw that this was a 4.5% interest rate, so fairly competitive interest rate. So if you've got more than a 4.5% interest rate, you're paying double or maybe even more than double on your mortgage. They don't tell you that when you sign up for the mortgage. All they tell you is, hey, 4.5%, right? That's way better than anything else that's out there. And we think, it's true. It's way better than anything else that's out there because they told us that. And we just agree with them because we don't know what the heck we're talking about, right? But by getting educated on this stuff and understanding how this stuff is actually calculated, you realize that in these types of loans with amortized interest, in the case of a 30-year amortization, you're paying double, sometimes a little less than double, but a lot of times more than double the principal amount that you actually borrowed. So it's crazy. Now, in contrast, let's look at daily simple interest in lines of credit. The characteristics of a line of credit and daily simple interest is repayment is formulated by a percentage of the outstanding balance. The repayment period is a function of the interest rate and the outstanding balance, and it's typically a higher advertised rate. They do that, again, to scare you, like we talked about in Module 2. In Module 1, the whole idea behind a line of credit is they want you to have one, but they don't want you to use it unless you're desperate, so that you'll end up stretching out the amount of time that you take to pay back that loan, and thereby paying more in interest. The whole idea behind this is they want you to take more time, because the more time they can get you to take, the more interest that they can collect. So by using speed banking, we're drastically reducing the amount of time that we're paying back debt, thereby bypassing a whole lot of this interest. So on a monthly interest-only payment formula, obviously it's much cheaper. We take our interest rate, we times it by the principal, and divide that by the number of days in a year, 365, or on a leap year, 366. And then we times that by the number of days in a month. So if we're looking at how the interest is paid, the formula for that is the interest rate times the principal divided by the number of months in a year, which is always 12, and times by the number of payments made, which can be variable. So the result is the difference between a loan and a line on $400,000. And if we just want to take just a fraction of that, let's say, okay, on this $400,000 loan, 4.5% interest on the loan, on the amortized loan, or in this case, it was 6% interest on this slide that I used. So the math is correct here for 6% interest. On $24,000 that I want to pay off in principal, I'm going to pay about $90,000 in the front end of that amortization, and it's going to take me about 4 years. However, in a line of credit at 21% simple interest rate, which is a little bit of a that's kind of a high interest rate on a credit card. But to pay off $24,000 at 21%, we are looking at the difference of about 3.5 years, and the difference of $87,000. $87,000 that we're going to be paying in interest. So obviously much cheaper to do it with a line of credit. Obviously, yeah, $87,748 in total interest that we save just simply by using a line of credit, even though it has a higher interest rate. So point being here, we're going to take advantage of the revolving nature. We're going to take advantage of the daily simple interest formula that they use versus the amortized formula that they use in mortgages, which tends to, like I said, it front end loads the interest and it tends to stretch out the amount of time that it takes to pay us back or to pay it back. So, if this is you, if you got a $400,000 house at around 6% interest, anywhere from 4.5 to 6% interest, this is the kind of savings that we're talking about over a 6 month to 4 year period, just by simply applying the speed banking strategies. Now, remember that saving interest is just as good as earning interest. So that's a principle that we're going to be using as we continue through this. So that wraps up the understanding interest portion. This was module 5. Hopefully you guys got some good stuff out of that. In the next module, we're going to be jumping in and talking about why the traditional way doesn't work. That will be in module 6. I will see you guys over there.